Welcome to the Industry Angel Podcast. We hear from the best business minds across the globe. Entrepreneurs, social influencers, marketing mavens, and sales rock stars. We've got them all. Here comes your weekly dose of inspiration with your host, Ian Farrer.
Welcome to episode 64 of the Industry Angel. Mid-September already. Less than 100 days till Christmas. I know, don't shoot the messenger. What it does, it allows us to plan our strategy, you see. We can have a great last quarter and we can finish the year off in style. So let me know your plans, host@industryangel.com. Thanks for everyone's emails and tweets and messages. We'll be doing some shout outs in the next couple of episodes. So today, let's get onto a topic we haven't covered yet. Today we have with us mobile home park investment expert. Welcome to the Industry Angel, Jefferson Lilly.
Ian, it's great to be with you. Cheers.
Well, you're British already with the cheers, eh?
I guess so. Yes, indeed.
Well, before we get started thinking about British and US and terminology, so in the UK, a mobile home could be a camper van or what you might call an RV, or sometimes we call it a static caravan. Do you guys call them trailers? So you're going to have to put me at, what is it? What is a mobile home?
Yes, well, we use those terms interchangeably, both mobile home and trailer. Some people here in the U.S. are trying to make them sound very fancy by calling it manufactured housing. But honestly, 80% of my prospective tenants call in and they say, hey, do you have any trailers for rent? And the other 20% say, hey, have you got any mobiles or mobile homes for rent? Right. None of our actual tenants ever use the term manufactured housing. So we just go with trailer or mobile home.
It's funny, trailer here. A trailer is something you'd attach to a car and drag along because you trail it behind you.
Yes. Yeah, that's where the industry got started really after the war. Right. It was with small, everything was small. Everything was really a quote unquote trailer. And then I think it was some point in the 1960s that some trailers became large enough that they could no longer be towed behind a regular automobile. They had to have a special truck pull them, and they started getting set permanently in what had been really more temporary or vacation or holiday, trailer courts, or caravan parks. And so, somewhere in the 60s, they got much bigger and started getting quote unquote permanently attached to the land. And that's kind of when some of them, started referring to them as mobile homes.
Well, that brings us nicely to the fact that you're a mobile home park investment. So what does that mean? Does that mean that you own a load of mobile homes, or do you own the park? How does it work?
Yeah, so our goal is always to own the land. We think about this business very much like being a parking lot, with very permanent quote unquote cars, so to speak, parked on the land. But the value really is in the land. We do deal in the trailers, the mobile homes themselves when needed. We don't really tend to mark them up or make much of a profit. We will provide financing on any mobile home, say that might get abandoned in a park. We'll put in $4,000 or $5,000 US, fix them up, and then put them out on a rent to own agreement and help lower income folks become homeowners. But our goal in the long run is really just to own the land. And again, we're happy to sell on the mobile homes and not really own those for any longer than we need to.
You mentioned something here about low income, and that's something we face here in the UK, is a demand for affordable housing. Mm-hmm. So is that something, are trailer parks becoming popular because of that there is no affordable housing over there?
Yeah, mobile home parks are really the only path in the U.S., and I think, I'm not an expert in the whole world, but I think pretty much worldwide, mobile home parks, really mobile homes, are the only path to home ownership that low income folks have. Our typical customer is, say a couple maybe in their 30s that has a couple of kids. they might work at a fast food restaurant, or, he's a truck delivery guy and she, works part-time at a hair salon, or what have you. But on average, I think our average household income of our tenants is probably $30,000 US, maybe 35. And frankly, folks earning that amount of income are not likely to be able to save up, say, $20,000 to put down on even a modest $100,000 house. Whereas we can help them maybe just for as little as $1,000 or $2,000 down. We can put them on a path to owning, say, a three-bedroom mobile home, 3-bedroom, 2-bath, maybe 1,280 square feet for just a couple $1,000s down, and probably not more than $800 a month US. So that's more affordable than traditional, regular site-built housing. So really, other than being in a mobile home park, these folks aren't likely to ever own their own home. They'd be in a lower income apartment building and would be trapped in that game of paying rent forever. Whereas in our world, they might become a homeowner in 5 years, certainly in 10. And then they just pay the lot rent. They've got no more home payment. Their lot rent might be, say, $300, and that's a much better deal than being in an apartment at that point. And again, you actually own your own home. You've got some equity in it. If you want to sell it, you can recoup some of your investment. So this is really a unique niche, and really the only path to home ownership for lower income folks.
What's the lifespan of the trailer, Jefferson?
Gosh, probably at least 50 years.
Wow.
I've got some trailers as old as that in some of our communities. And obviously those are trailers that were built back, say, in the 1960s. If they're still around, I would certainly think that more modern homes, and frankly, modern mobile homes are built, with 2x6 walls, double pane windows, vinyl siding, shingle roof, really all the same things that a regular house is built with. That's what they use now to build a modern mobile home. They put it on a chassis. It's got wheels. It is mobile, but basically from the floorboards up, it's almost identical to a regular house. So I'd certainly think that if, houses from the 60s, or some of them are still around, that houses built today will certainly be around for 50 years, maybe longer.
So, I mean, like you say, that's a kind of route to get on the ladder to house ownership, or, property ownership.
Yep.
Does that mean that the authorities are assisting people to get onto this ladder, or are the authorities not really interested in this?
It's you raise a very interesting question there. So one of the things that makes this such a good business to be in, frankly, as a landowner, is that the authorities, as you call them, the local authorities, pretty much every city and county here in the U.S. has outlawed any new construction of mobile home parks. That's been a trend over approximately the last 30 years. So, they view them as being dirty. And frankly, most authorities are middle class or better. If you have the skills to organize a political campaign, to raise donations, to present yourself and get elected, frankly, you're almost certainly not lower income. Most of the authorities are middle and upper class folks. And they unfortunately look down on mobile home parks as being, dirty, full of crime. Honestly, that's not really true. There was finally a study that came out, I think, a couple years ago that proved that mobile home parks do not have a higher rate of crime compared to their surrounding regular, site-built house neighborhoods. But this niche unfairly gets a bad reputation. So the authorities do interfere. They don't allow new mobile home parks to get built. So if you own one of these, you're really participating in a government-enforced oligopoly. You'll never have any new competition. You have competition, but it's fixed. You won't have any new competition. And frankly, competing parks do go away slowly but surely, about 1% a year. Parks get plowed under. They get redeveloped into a fancy shopping mall, a residential neighborhood, apartment building, what have you. So really the supply of mobile home parks is going away about 1% a year. At the same time, demand increases proportionate with population growth. Here in the US, that's about 1% a year. So again, demand grows about 1% a year. Supply shrinks about 1% a year, largely because of the authorities interfering in this market. But frankly, that creates quite a favorable investment dynamic if you own the land. And again, your competition is going away, and demand continues fairly strong. Frankly, it's not that hard to make a decent amount of money in this business.
Well, that leads us nicely into you, Jefferson. So essentially, your interest in the land, you're not so much interested in the housing, it's more so the land that they're on, yeah, so they can pay you rent?
Yeah, exactly. We'll get into the houses just to help people afford, well, we don't want any abandoned houses sitting in our communities, right? That's both
Sure.
a wasted profit opportunity, and it's also a health hazard. We don't want kids climbing in and out of abandoned trailers. So we fix those up. And then, a typical deal for us might even have 5 or 10% totally vacant pads. That's where the house sits. We call it a pad. So we'll buy usually brand new homes from the factory, bring those in, infill those vacant pads, and again, put those homes out on rent to own agreement. Those might go for more like $3,000 down. But one way or the other, we get the homes fixed up. We buy new. We're actually expanding the supply of affordable housing. And then again, after say 5 to 10 years, our residents have bought those homes from us, and we're back to just owning the land.
So what are you interested in, Jefferson? Is it the individual pads on parks everywhere, or is it the full park and all the pads?
Oh yeah, we buy the whole park. A typical size acquisition for us is right now probably right around 100 pads, and we are typically paying, I don't know, anywhere sort of $20,000 to $30,000 per pad. So that means a $2 to $3 million acquisition of that 100 space park is roughly what we pay.
And what do you do? Do you work it out as how much rent you're going to get over the amount of years that you've borrowed the money to buy it, or how does it work?
Yeah, we'll finance the parks basically one of three ways. We may just go to a bank and get a mortgage. We may go to Wall Street on larger deals. Here we have something called CMBS financing, which stands for collateralized mortgage-backed securities financing. Basically, that means Wall Street basically will lend us the money. They'll then sell off the mortgage, our mortgage pooled with, 100 or several hundred other mortgages. And then investors that are looking for, fixed income returns will buy those pools of mortgages and obviously collect all the mortgage payments. So we've done that on some of our larger deals. There's a minimum of right now roughly around $1.5 million to $2 million in debt per deal. But anyway, our larger deals, we've done CMBS, and a couple of our deals we've gotten seller carry. The seller just carries back the mortgage. Maybe they want us to put down, 25% down, and they say pay us out the remaining 75% over some number of years. So, works just the same in that way as a bank, except instead of paying the bank over time, we pay the person that sold us the property over time. So we finance the parks a number of different ways. We then improve the parks, fix potholes, fix up abandoned homes, probably bump the rents, and infill vacant pads. And, pretty soon the park's better for us. It's better for tenants. They've got a safer community that's been fixed up. We view it as a win-win.
So it's a bit easier than buying property and having to repair, housing and kitchens and toilets and stairwells. And is that what you're getting at? It's a bit easier to maintain.
Exactly. You've hit one of the nails on the head about why this is such a good business. We don't. We might own 5 or 10% of the houses, but even then, they're on a rent to own agreement, and the tenant should be taking care of them. But basically, we don't really own the proverbial leaky toilets and leaky roofs. So that's one of the things that makes this such a better niche than, for instance, buying apartment buildings where you're dealing with all those leaky toilets and leaky roofs that you have to repair. And frankly, you're dealing generally with a less responsible tenant base. Many of our tenants, again, have self-selected and risen up out of apartment buildings to live in a mobile home. Now, it might not be as nice of a home as you or I live in, Ian, but they show pride of ownership. When you give somebody a chance at owning something, they take better care of it than when they're a
Yeah.
renter. So really, you could take a mediocre renter, somebody that kind of abused the property a bit in an apartment building, give them a shot at owning a mobile home, and they're likely again to become a better tenant, to treat it better because they really see the light at the end of the tunnel. They're on a path to actually owning something significant in their lives for maybe the first time.
So this investment, from your point of view, it doesn't sound like a short term, buy it, flip it. This sounds like you're in it for how many years would you be in this?
Yeah, so I own a couple of parks on my own that basically I'm planning to own, forever. I don't have any
Right.
plan to sell, and if I pass those parks on to my kids someday, I'm perfectly fine with that. Our partnership, Park Street Partners, does have our funds have a 10-year life. So we,
Okay.
we don't really fix and flip. We might fix and refinance, pull some of our capital back out, but without selling the park. We might do that maybe over the first 3 years. But basically, we plan to hold parks for about a decade, cash flow out of them. And we're just in this now about 3 years. We've got our first fund, has still got about another 7 years to go. So who knows at that point? Maybe all of our investors will say, "Hey, let's keep the party going," and we'll just all mutually agree to extend. But our funds again do have a finite life. So if our investors want their capital back, then at the end of the 10-year fund, we'll then be selling the parks and returning still more capital to our investors.
So who invests in this then, Jefferson, and why would they do it over something else? What is there a larger return?
Yes, we think so. Yeah, our first fund, which is still maturing, it still has some vacant pads and is infilling, but our first fund from a couple of years ago is returning about 12% cash to our investors. We pay out quarterly, so they're receiving a dividend check of about 3% per quarter. And then we think appreciation will add, another 6 or 8% on top of that. The appreciation gets recognized in a somewhat lumpy fashion, say at year 3 when we refinance, and then maybe at year 10 when we sell. But that should add again another 6-8% to their return. So overall, folks should be compounding their money, we think, around 20% a year. Now, no guarantees here. I don't want to go into all the small print. I'm not guaranteeing anybody's financial return, but we've got a track record, again, for several years now, paying out about 12% a year. And we're just getting around a bit later this year to refinancing for some of our properties and getting our investors larger chunks of capital back. But that's what we think. This is a very low risk business. This is not like
Is it?
doing high tech,
Right.
biotech, solar tech, silly tech investing. This is just basic affordable housing, right? Food, shelter, clothing, the three basic necessities of life are necessities in good times and in bad. Anyway, so we view this as being a very low risk business. And frankly, getting around 20% on your money is almost like sexy venture capital returns, which that whole world, of course, is higher risk and much more volatile. And we're very stable and low risk. And there's certainly a market out there for folks that'll want to take on more risk and go do high tech angel investing and try and back the next Google, but for folks maybe that are a little older in life or want a more stable income going into retirement, this is quite appealing to a good segment of investors. All individual investors so far, where our funds are typically around 10 million, maybe 15 million dollars US. So we're not raising money from the California teachers retirement fund, which is billions and billions of dollars. We're too small for that. This is a niche, but it's perfect for high net worth folks that might want to invest $50,000 on up to a million or two. So that's who our investors are. They're all, at least so far, all individual investors.
You weren't talking about risk there, and you also mentioned Wall Street.
Yep.
So straight away, my ears pricked up. So what happened in '08 then? The housing crash and things like that. Did that affect your industry?
Yeah. So that's interesting. I purchased my first park in March of '07, which Ian was probably to the month, to the week, and maybe to the day.
Sure.
The end of the high point in the housing market was like March of '07, and from there it started to
Yeah.
slide. And by late '07, '08, it was just in free fall. So what happened with my park? That first park was in Oklahoma City, Oklahoma. So that's the great American Midwest. It's frankly
Sure.
generally not a place for sexy real estate. So, the housing crisis really, as I've heard, that something like 80% of all the mortgage defaults occurred in like 25 zip codes. So it got a lot of press, but it was not, yeah, it
Really?
was not really
Oh,
a nationwide affair. If you had bought a home in Eastern LA or Las Vegas or Phoenix or Miami, those were really the markets where there were the most numbers of these liar loans, and the housing market got hit the hardest. But the housing market, the regular housing market, frankly, continued to move up in value in Oklahoma City all through that. Now, the rate of growth, the rate of appreciation did slow, but still, the housing in Oklahoma City was up year after year. And my experience with my park between about '07 and '09 was that we remained 95 to 100% full. Uh, we did also increase rents almost 50%. From about $110, which was way below market, to about $155 a month. But still, that was about a 50% increase over those couple of years. And we remained, again, 95 to 100% full. So the housing crisis had really no material impact on my business. And I've actually gone back and looked at, there are three publicly traded REITs, publicly traded companies here in the US that specialize in owning and operating mobile home parks. And what happened with those guys was they also continued to deliver very strong cash flow, actually hit all-time highs in cash paid out to their investors in that '07, '08, '09 time period. Now, the market didn't believe it. The market sold off those stocks by about 45% at the depths. So just as the publicly traded companies literally were delivering their highest cash flow ever, the stocks were down 45%. So the public market investors ran for the hills. They got scared, but the underlying performance of the business literally hit all-time highs. It just always goes up, basically, is the bottom line. It's not specifically counter-cyclical. It's just always a growing business. And I saw that again, both with my first park and again, going back and looking at the results from the publicly traded companies. They did well as well. So housing collapse was not really a factor for us. Again, unless you owned a park right in Las Vegas or Phoenix or Miami, one of these relatively few markets where the bubble did get built up very large and burst. But most of America was just fine.
I didn't expect you to say that.
There you
So
go.
when you're looking, well, yeah. So when you're looking for parks, I mean, I don't know if you're looking for more to invest in, but is location something really big for you? So obviously, what we've just seen there with the Hurricane Irma, there,
Yep.
do you sort of stay away from these risky places?
You know, we buy wherever the cash flows. So honestly, that first park
Okay.
that I mentioned in Oklahoma City, it's on the south side of it. It's right in what we call Tornado Alley. Thankfully, I've not been hit. But it was and continues to be a good deal. We did also just purchase a park in Lakeland, Florida, which is between Tampa and Orlando. Hurricane Irma, literally, the eye wall went like right over our park. We did lose one mobile home. That's out of, I believe that park has, I think, 73 mobile homes. So we lost one, and that was unfortunate due to falling trees. Um, so we certainly don't. I'm mentioning the ones that are in nature's fury, the path of nature's fury. Most of our parks, we've got 19 parks, and most of them aren't obviously in Florida or Tornado Alley of Oklahoma. We've got parks in Spokane, Washington, and Raleigh, Durham, North Carolina, and Superior, Wisconsin, and Midland, Michigan, and most of our parks are nowhere near anywhere that a tornado or hurricane would ever hit. But again, our motto is that there are no bad deals; they're just bad prices to pay. And if you get a park, at the right price that compensates for whatever the weather risk might be, then we'd be a buyer. Again, we've got now a good portfolio. Thankfully, nothing's taken a direct hit. If it did, we think we could suffer the loss and rebuild. And again, if the pricing is right, obviously it's kind of a bit of an insurance game. If the price is right, you're going to do well over time, even if you take the occasional loss. That's basically the way we look at it.
So you mentioned that you've got 19 parks. So from an operational point of view, I need to know how what do you have? Someone on site on each one, and then a little office, and then everyone pooling separately? How does it work?
Right. Yeah, that's generally it. So so all of our parks do have an on-site manager. And Ian, what we look for there, first off, we may just keep on the manager that the previous owner had. It's rare that we fire a previous manager. It has happened where we've seen signs of real incompetence or embezzlement or something, but that's rare. So usually we just keep on the manager. But frankly, this is a very mom and pop business.
Yeah.
So approximately half of our parks have not come with a manager because mom and pop were running the park, and they're now, say, old. The kids are off doing sensible things like being doctors and lawyers, and the kids don't want anything to do with the dirty mobile home park. So literally half of the parks come with no manager because mom and pop are now selling the park and obviously don't want to continue to manage it. So in that case, we'll look for somebody to manage the park who already lives in the park and probably owns their own home, and really ideally has one of the nicest homes in the community. Now, that doesn't mean the newest home, but just a home that's well kept, probably been painted, even if it's older. The lawn is mowed. We want to see somebody that shows pride of ownership with their own home. And so not all the homes, of course, are going to be, excellent, but pretty much every park has got 5 or 10% of the homes that really stand out as being, clearly occupied by people that really care about appearances and show pride of ownership. So those are the doors that we knock on. And so, typically it's not hard to find somebody from within the community that wants to manage it, because then they say, hey, I get to fix up the community. I get to try and get everybody to fix up their house as nice as mine. That's the kind of attitude that you look for in an on-site manager. Virtually all our parks have an on-site manager that fits that bill, a longtime resident that owns their home.
And then I was going to say, do you have to supply them with all the tools, all the operational tools, so that the technology to be able to report and send you things up to the head office?
Typically not. So we are very driven by technology, and we can get into that in just a moment here. But basically, if somebody comes to us and they've got that, amazing house with the nicely cut lawn, but, they don't have a cell phone, they don't have a computer, that's typically a deal killer right there. That would almost certainly rule someone out from being able to be our manager. So really our standards, again, are that somebody not only show pride of ownership with their home, but also that they show a certain level of technological sophistication. We don't expect them to be, coding software or releasing apps on, the Apple iTunes website. But we do expect that they already have a cell phone, that they probably already have email in that cell phone or at least on their desktop computer. Because again, we're remote. I'm here in San Francisco. My partner's down in the greater Los Angeles area. We actually don't own any properties here in California. We're coast to coast, but none of it, at least so far, is in California. We want people to be able to, heaven forbid, like with that tornado, or sorry, with the hurricane, we want a manager to be able to go and snap a photo with his or her phone and text it to us or email it or upload it into Dropbox. And then we at headquarters can kind of make a decision, what are we going to do about that home? Is it repairable, or do we, have to scrap it out and bring in a new home? Anyway, similarly with taking photos of signed leases, scanning them, uploading those into Dropbox, we need a manager that has a certain minimum level of technological, familiarity and skills. And basically that just means we need somebody that knows how to send a text message and send an email with an attachment.
Yeah.
But again, in this day and age, it's not the 1990s anymore. In this day and age, pretty much everybody, even in a mobile home park, has got a fairly nice new phone and has probably got a desktop computer. And again, that's really all we need then to have a manager be able to communicate with us remotely. And so that's the basics of how we manage a park remotely, is with these on-site managers who have a basic level of technological sophistication.
So all the financials are just taken care of via sort of direct debits. Like the
Good question.
The local managers wouldn't touch any money, no?
Yeah, so here's how we handle that, and tech plays again a big role. So first off, we'll tell the manager, we'll tell the manager to put up notices on everybody's door that the park no longer accepts cash. Sometimes that's a bigger cultural change than others. Some parks have already been run that way. Some parks have been run, where literally 2/3 of the rent comes in by cash. We don't accept cash for both the obvious reason of embezzlement and the less obvious but still equally real issue of safety. Frankly, many of our managers are senior citizens. Let's just say they're not, bodybuilders, 20-something-year-olds that carry a weapon with them. We don't want word getting around that a 55, 65-year-old park manager is collecting $5,000 or $10,000 cash in their home, the first couple of days of every month. So we accept no cash. We then actually do our accounting through a software program called Rent Manager, which is focused just on the multifamily business. So Rent Manager then also, you can hook up a check scanner to it. So our managers now, again, are only accepting checks or money orders. We give them a check scanner, and when the rent comes in, they just scan it through, right from the convenience of their kitchen counter or their home office. They just scan all those payments, and it both, of course, deposits the money in our bank account, and it updates Rent Manager with who's paid and who's not. So now there's no conflict or confusion. Managers, I guess, can still keep track, say, if they want, on a spiral bound notebook, and write down things by hand if they want. But really, that Rent Manager stays in sync, because literally every time money goes into our bank, it has to be allocated out to a tenant. And so again, that enables us both to do our rent roll accurately, and to get money in the bank, and to have no real risk of embezzlement or safety issues, because we're not collecting cash. So then we can all look at Rent Manager remotely and, see how a park is performing, and frankly also see how a manager is performing. If a manager is not depositing the rent on time, or is not charging late fees, then that all gets flagged in the system, and we have a conversation with the manager as needed. And or again, the manager has a conversation with the tenants as needed to make sure they're paying on time, make sure the manager then is depositing things on time. And we do accept some online payments as well. That's typically with a credit card. But our tenants do have that option to pay that way. So basically, any way other than cash. I guess we don't
Sure.
yet accept Bitcoin, but maybe talk to me in another year, see if we're taking
Yeah.
digital currencies as payment, or maybe that's all going to be proved to be a big Ponzi scheme. I don't know, but anyway, we take all normal forms of electronic money right now.
I was just going to say, in terms of investment, that might be an interesting one because it seems to be flying.
Yep.
So, thinking about technology, then you guys also run a podcast. So this is super niche. So you get some
Yeah.
good downloads on your podcast. So who are listening? Who's listening to this?
Yeah, we get about 10,000 downloads a month. Our podcast is simply called Mobile Home Park Investors. Folks can find it in iTunes, Stitcher, and I think we're also up on Google Play. Or our website is simply mobilehomeparkinvestors.com. Um, but yeah, Ian, I think it's my mother out there downloading my podcast 10,000 times a month just to make me feel good about myself. Uh, no, but seriously, we think I mean, of course, we don't know, by name. You're in this business, you get some sense geographically, but you never know by name who's downloading your podcast. But we do get a lot of unsolicited email then from folks, and a typical profile is somebody that either already owns, say, a mobile home park. They might be a mom and pop, or it's folks that are looking to achieve financial independence. They've probably already bought and owned maybe a single family house or a duplex or a quadplex, and they've now stumbled upon our podcast and are beginning to see the light that mobile home parks are a better way to invest than doing single family houses or apartments or what have you. So it's either, again, park owners or wanna be, soon to be park owners.
Yeah.
Anyway, so that's who we think our audience is. But I do also know, for instance, I get also some comments from people that are brokers, mobile home park brokers, or even mortgage brokers in this business. So it's spreading out now to people that are supporting the business. Brokerage, also insurance brokers and stuff. But so I do also hear from some industry people that they're listening to the podcast. But again, we think it's mostly individual investors that already own a park or want to own a park, people that are focused on being financially independent. That we think is the bulk of our listenership.
Yeah, I think you must be a big influencer in your field, Jefferson. You're getting all these people into the industry, you see.
Yes, indeed. Well, the funny thing is, I can name, I won't, but I could name by name people that now have left Google, Goldman Sachs, and I think Apple to get into the mobile home park business. So
But isn't Warren Buffett in it as well? Isn't he
he
manufacture them or something?
is. Yeah. So the way Buffett got into this was a little before I got into it. He bought a company called Clayton Manufacturing.
That's right. Yeah.
Clayton at the time had about 25% market share for manufacturing mobile homes here, principally in the U.S. And then they did own some mobile home parks, but the bulk of that company's assets were really on the manufacturing side for producing the mobile homes. That was already a publicly traded company. But yeah, Warren Buffett of Berkshire Hathaway bought that company, I think, for $1.6 billion. I think that was
That's a
back in,
drop in the ocean for him. That's
yeah, for him,
nothing.
right, exactly. But that was, I don't know, sometime back around 2003, 4, something like that.
Right.
So
Uh-huh.
he did sell off the mobile homes. I think Buffett is particularly averse to any sort of bad PR or personal confrontation. And he didn't want to have, the headlines read, evil billionaire raises rent on little old lady.
Right.
But
I see.
we won't talk politics, but there's certain
Yeah.
media outlets that would have spun the story that
Sure.
negatively. Anyway, so he's retained the manufacturing capacity and expanded it. I think, frankly, Clayton Homes is now up to about 45% market share. But I mentioned earlier that we buy new homes. We do that almost exclusively through one of the Clayton brands. They've got a bunch of different brands, and of course Clayton is their flagship brand. But anyway, they also provide financing for some of these new mobile homes. So anyway, that's how we are infilling our parks with brand new mobile homes, is by working with this subsidiary of Berkshire Hathaway to again bring in and finance those homes and expand the supply of affordable housing.
So it's you who's lining Buffett's pockets then. That's what we're saying.
Well,
here.
it works both ways, I mean, they finance the house, and then we collect the lot rent, underneath the house. They collect the payment for the house. We collect the payment for the lot rent. So, we're all lining one another's pockets. It's wonderful when you have a true win-win, and we're very happy with Warren Buffett being in this business, and we're happy to make him a little richer. He's making us a little richer, and life is good.
Well, Jefferson, thanks so much for that insight. It's been really interesting, and probably, certainly I and certainly listeners probably weren't aware of some of this that goes on. So thanks very much for that.
Yeah, it's been great to be on your show. For anybody that's interested, our company's website is simply parkstreetpartners.com. And we've both got resources there for your listeners that might want to get into the business themselves, or if it sounds a little too hairy and they just want to co-own parks with us. We are just about to open our next fund, and there's information for that as well. parkstreetpartners.com.
Brilliant stuff. I'll link up to that in the show notes.
Fantastic.
So, Jefferson, I wish you well. This sounds amazing, and best of luck.
Yeah, feel free to have me back on in a year. See if I'm taking Bitcoin or just what's happened to my world. It's rapidly changing and exciting.
Brilliant stuff. Well, you can kick Warren Buffett out and you'll be the top man.
Yeah,
then.
That's my goal. We'll see if I can accomplish that in the next year. I doubt it, but anyway. Okay.
We'll see you next year then.
Thank you so much for having me on. Cheers, mate. Bye-bye.
Thanks to Jefferson Lilly there. It's interesting here in the UK, over the last 20 years or so, we've experienced a significant rise in house prices. And quite often people will try to get a second property to rent out, as a bit of income, but it's become harder to afford due to the mortgage and, putting the deposit down, your loan to value rate, and the subsequent rent might not cover the mortgage repayment. You might experience a difficult tenant like we see on some of these TV shows, and it could end up costing you rather than make a profit. So I hadn't thought about the mobile home parks though, so that was interesting from Jefferson. It seems to provide a good return without the issues that can arise with house ownership. So food for thought. So there you go, another topic ticked off the list. My name's Ian Farrer. This is the Industry Angel, and thanks for listening.